Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about KENVUE INC quarterly report. KENVUE Inc. offers a diverse range of consumer health products across various segments. The company's business portfolio includes self-care, cough, cold and allergy, pain care, digestive health, smoking cessation, eye care, and other products under brands such as Tylenol, Motrin, Benadryl, Nicorette, Zarbee's, ORSLTM, Rhinocort, Calpol, and Zeotech. Skin health and beauty, face and body care, hair, sun, and other care products under Neutrogena, Aveeno, Dr. CI, Labo, Le Petit Marseillais, Lubriderm, Rogaine, and OGX brand names. Essential health. Oral and baby, women's health, wound, and other care products under Listerine, Johnson's, Band-Aid, Stayfree, OB, tampons, Carefree, and Desitin diaper rash brands. The stock price of KENVUE Inc. has dropped significantly over the past year due to a combination of factors. The most notable contributor to this decline is the controversy surrounding Tylenol, one of KENVUE's flagship products. Public discourse and potential regulatory action regarding acetaminophen use during pregnancy have led to negative press, heightened scrutiny, and potential lawsuits. Additionally, a forthcoming report from the U.S. Department of Health and Human Services, HHS, examining links between acetaminophen and autism has created headline risk for KENVUE. The company's weak financial performance, including a decline in organic sales across all segments, has also contributed to investor concern. Analyst downgrades, leadership changes, and strategic reviews have further added to market uncertainty. These factors have collectively led to a 28.12% drop in KENVUE's stock price over the past year, with some reports indicating a decline as high as 34%. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. Net sales decreased by $135 million due to volume-related decreases and unfavorable value realization. Volume-related decreases were observed across various segments, ranging from -4% to -2%. However, currency translations had a positive impact on revenue in the self-care and essential health segments. On the other hand, certain expenses also affected revenue growth or decline. Amortization expense decreased revenue by $66 million for both fiscal periods, while intangible asset impairments recognized in 2024 decreased revenue by $479 million. Additionally, restructuring expenses increased from $38 million to $97 million between 2024 and 2025. In conclusion, the primary drivers of revenue growth or decline are largely influenced by net sales, volume-related decreases, unfavorable value realization, and certain expenses such as amortization expense and intangible asset impairments. Net income and profit margins. A mixed picture. The financial summary reveals a mixed picture of net income and profit margins. On one hand, net income has shown an increase, rising to $398 million in the 3 months ended September 28, 2025, from $383 million in 2024. This trend continues for the 9-month period, with net income reaching $1,140 million in 2025, compared to $737 million in 2024. However, profit margins have taken a hit. The gross profit margin has decreased to 59.2% in the 3 months ended September 28, 2025, from 58.3% in 2024. Similarly, the operating income margin has also declined to 16.7% in the same period. The reasons behind these changes are varied. Net income increased due to several factors, including supply chain optimization initiatives and reduced stock-based compensation expense. On the other hand, profit margins decreased due to unfavorable value realization, higher expenses related to brand support, and tariffs imposed on imported goods. The company's financial performance indicates a consistent trend of generating positive operating cash flow. The net cash flows from operating activities have shown an increase from $976 in 2024 to $1,343 in 2025, demonstrating the company's ability to generate sufficient cash from its core operations. This is a significant indicator of the company's financial health and stability. And the company's debt levels and interest expenses have undergone significant changes over the past year. While total liabilities initially increased by 4% in the early period, they surged by a substantial 23% later on, reaching $37 million. Total debt also saw a notable rise of 4.6%, from $8,607 million to $8,973 million. However, interest expenses have been relatively stable, with only minor fluctuations. The net interest expense for the fiscal 3 months and 9 months periods remained largely unchanged, decreasing by just $3 million and $2 million respectively. A significant increase in commercial paper, rising 45% from $800 million to $1,160 million, is also worth noting. The most notable change was a one-time debt increase of $1,136 million due to the termination fee. Overall, while there have been some fluctuations, the company's interest expenses have remained relatively stable, but its debt levels have seen significant increases in certain periods. The company's financial performance varied across different segments and regions. Notably, the self-care and essential health segments excelled in their respective areas. Conversely, skin health and beauty, as well as pediatric pain care and allergy care, struggled due to unfavorable value realization and lower seasonal incidences. Geographically, China and the United States experienced declines in performance. The former was impacted by volume-related decreases, while the latter faced trade inventory reductions driven by retailer inventory management. Management is expressing caution regarding the company's outlook due to macroeconomic developments, tariffs, and trade restrictions. They acknowledge volume-related decreases in certain markets and market softness in Asia-Pacific, but are offsetting these challenges with growth in smoking cessation in Europe, Middle East, and Africa. The company expects to continue paying cash dividends and has adequate liquidity to meet its obligations. However, the merger agreement may limit future deal-making opportunities and regulatory approvals may impact the transaction's benefits. Acquisitions and divestitures overview. Johnson & Johnson, J&J, has made strategic business moves through acquisitions and divestitures. Notably, the company acquired Pfizer's OTC business in 2006, gaining U.S. rights to OTC Zantac. On the other hand, J&J has also engaged in divestitures, including separating from its parent company, proposing a transaction with Kimberly-Clark, and selling off various assets such as Dr. C.I., Labo's skin health business, and its former corporate headquarters in Skillman, New Jersey. These moves have resulted in minor reductions to net sales in the skin health and beauty segment. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In recent years, the company has paid out significant dividends, totaling $1,183 million in 2025 and $1,159 million in 2024. Additionally, the company has also engaged in share buyback activities, repurchasing shares worth $197 million in 2025 and $114 million in 2024. Concerns about inventory buildup or supply chain disruption are evident in the financial summary. Notable points include a 12.7% increase in total inventories from December 2024 to September 2025, trade inventory reductions driven by U.S. retailer management, and inventory builds in prior years impacting current period volume-related decreases. Additionally, changes in shipment timing in China and lower inventory replenishment due to prior year's buildup are also concerns. These factors indicate potential disruptions in the supply chain, which may have a significant impact on business operations. That concludes the financial summary for KENVUE INC. Feel free to comment below, and I will be happy to answer them when possible.